Imagine it is October of 1930. You are not a speculator, you are not a banker, you are not a person trying to get rich quickly, you are a grain farmer in rural Nebraska named Harold, and for 30 years you have done the simple, responsible things that society told you to do. You worked the land, you sold your harvest, you put the proceeds in the local bank, you trusted the building, the vault, the clerk, the name on the door, and the habit of life that told you money in the bank was money that belonged to you. Last month, after a hard year, you deposited $4,200 into the First National Bank in your town. That money was not abstract. It was not a number on a screen. It was the next spring's seed. It was winter food. It was fuel. It was the financial bridge between one harvest and the next. Then one Tuesday morning, you drive into town to withdraw $80 for supplies. There is a line outside the bank. At first, you do not understand what you are seeing. People are standing there with their hats pulled down and their coats buttoned tight. Some are whispering, some are angry, some are staring at the door as though staring harder might make it open. The door is locked. A handwritten sign is taped to the glass, closed until further notice. You push toward the front. You knock on the door. A clerk inside looks up, sees you, and then looks away. He will not meet your eyes. Your money is still inside. You can see the building. You can see the vault. You can see the place where you believed your savings were kept. But you will never touch that money again. Not $1. The bank has failed. There is no federal insurance standing behind you. There is no fast refund. There is no hotline, no appeal, no emergency facility, no political decision to make you whole. The money has not been stolen by a robber in the night. It has not disappeared in a stock market gamble that you chose to take. It has been deposited, trusted, absorbed into the banking system, and then erased. Within 2 years, roughly 9,000 American banks will close their doors in a similar way. A large share of the money Americans believe they owned will vanish from the practical lives of families, businesses, farmers, and towns. That is not a theory, that is history. And the reason this matters now is that the basic structure that made that possible has not disappeared. It has been softened by language. It has been covered with insurance. It has been surrounded by regulation. It has been made to look modern, stable, and sophisticated. But the most important principle remains the same when you deposit money into a bank. You are not placing cash into a private vault with your name on it. You are lending money to a private corporation. The bank becomes your counterparty. You become an unsecured creditor. And unsecured creditors do not stand first in line when an institution fails. That is not emotional language. It is the nature of the contract. Once you understand that, you begin to see the system differently. Most people believe a bank account is a storage box. They believe the money is there, waiting for them. They believe the bank is simply holding it on their behalf. They see the app. They see the number. They swipe the card. The payment clears. They transfer funds. The transfer works. And because access feels normal, they confuse access with ownership. But those are not the same thing. Access is a condition. Ownership is a legal reality. And in banking, the legal reality is more fragile than most people have ever been taught. When you put cash into a checking or savings account, the bank takes that cash and gives you a claim against the bank. The cash becomes part of the bank's balance sheet. The bank can lend it, invest it, pledge assets, take duration risk, and operate its business with it. You are left with a promise. Most of the time, that promise is honored. That is why the system feels safe. But most of the time is not the same as always. The difference between those two ideas is where financial crises live. In a liquidation, depositors do not magically float above every other claim. There are secured creditors. There are counterparties. There are contractual obligations. There are legal priorities. A person who believes money in a bank is the same thing as money in a vault is not seeing the machine clearly. And when people do not see the machine clearly, they are surprised by outcomes that were built into the machine all along. Now, you might say the Great Depression is ancient history. You might say the system has been fixed. You might say we have the FDIC now, and that is true. But before we talk about insurance, we need to understand what actually broke in 1929 and 1930, because the stock market crash was not the deepest mechanism. The crash of October 1929 is remembered because it was dramatic. Black Tuesday, headlines, panic, the Dow falling violently, the cultural images of brokers, windows, and ruin. But the real devastation spread through the banking system. It was slower, it was quieter, and it reached ordinary people who never owned a single share of stock. In 1929, the United States had around 25,000 commercial banks. They operated under fractional reserve banking, which is one of those phrases that sounds technical until you realize it is actually very simple. If you deposit $1,000, the bank does not keep $1,000 sitting in a vault for you. It keeps a fraction of the money as reserves and lends out the rest. The borrower spends or deposits that money, another bank receives it, keeps a fraction, and lends out the rest, again through that process. One original deposit can support many dollars of credit in the system. That is how modern banking creates money and credit. In good times, this looks like progress. Credit expands, businesses borrow. Homes are financed, farmers buy equipment, consumers spend, banks earn interest, depositors earn a little interest. Everyone feels wealthier. But the system has a structural vulnerability. The liabilities are short-term, the assets are long-term. Depositors can ask for their money at any time. The bank's loans cannot be called back at any time without destroying the borrowers. That mismatch is the heart of banking. It is also the heart of banking fragility in calm conditions. It works because not everyone asks for money at once. But if enough people do ask at once, the truth appears very quickly. The money is not there in the form people imagine it is there. It has been lent, it has been transformed, it has been turned into claims on the future. This is why confidence is the load-bearing wall of the entire banking system. It is not marble columns, it is not vault doors, it is not advertising. It is confidence. When confidence cracks, the mathematics reveal themselves. In late 1930, one important failure helped turn fear into a contagious force. The Bank of the United States collapsed in New York. Its name made it sound official, but it was a private institution. It had hundreds of thousands of depositors when it failed. People did what people always do when they sense danger before they understand it. They moved, they lined up, they tried to withdraw before others could withdraw. That behavior, taken individually, is rational. Taken collectively, it destroys the institution. One depositor trying to protect himself is prudence. 1,000 depositors doing it together is a bank run. Then the run spreads. If one bank fails, depositors at nearby banks ask whether their bank is really different. Rumor becomes action, action becomes shortage, shortage becomes panic. Panic becomes insolvency. From 1930 to 1933, more than 9,000 banks failed. Deposits wiped out exceeded $7 billion, which would be well over $140 billion in today's terms. Those losses were not only Wall Street losses, they were not only speculators being punished for taking risk, they were savings accounts, payroll accounts, farm accounts, small business accounts, the money people thought they had because they had done the responsible thing. That is the part history often fails to emphasize. The responsible thing can still be dangerous if the system you are relying on is misunderstood. The lesson is not that banks are evil. That is too simple. The lesson is that banks are leveraged maturity transformation machines. They take short-term money and fund longer-term assets. They work as long as the system's trust holds. They break when the claims against them are demanded faster than the assets can produce cash. That was true in the 1930s. It remains true in principle today after the Great Depression. The United States created the Federal Deposit Insurance Corporation. The goal was to restore confidence by saying that if your bank fails, insured deposits will be paid up to a certain limit. Originally, that limit was $2,500. Today, it is $250,000. For most ordinary depositors, FDIC insurance is a powerful stabilizer. It reduces the reason to run. It prevents a local bank failure from immediately turning into a national panic. It gives people confidence that small depositors will not be wiped out the way they were before. But every insurance system has a balance sheet. And a person who wants to understand risk must look at the balance sheet, not only the promise. The FDIC insurance fund is large in everyday terms, but compared with total insured deposits across the banking system, it is small. The source document points to an insurance fund of roughly $116 billion against more than $10 trillion of insured deposits, around 1.1% coverage. That does not mean the FDIC is useless. It means the FDIC is designed primarily for isolated failures, not for every major institution failing together at once. One bank here, one bank there, a contained problem, a managed resolution. That is the design. If multiple large institutions fail at the same time, the fund itself is not the real backstop. The real backstop becomes the Treasury, the Federal Reserve, and the political system's willingness to create or mobilize money to stabilize confidence. That is why it is important to distinguish insurance from systemic rescue. Insurance is a funded pool. Systemic rescue is a policy decision. Those are different kinds of safety. One is contractual within limits. The other is discretionary under stress. The collapse of Silicon Valley Bank in 2023 made this visible to anyone willing to look carefully. A very large share of deposits at that bank were uninsured because they exceeded the $250,000 limit. The government decided to protect all depositors because the risk of contagion was judged to be systemic. That action stabilized confidence. But it was not a universal rule that every uninsured depositor in every future bank failure must always be made whole. It was a decision. And in a crisis, decisions depend on the circumstances, the politics, the size of the institution, the perceived risk of contagion, and the people in charge. That is not the same as certainty. For deposits below the insurance limit, there is more protection, but even then, access can be interrupted while regulators resolve the institution. For deposits above the limit, the question becomes more complicated. If your uninsured money sits in a failed institution, the outcome can depend on whether the government sees your bank's failure as a systemic threat or just a private loss. That is a very different type of risk than most people think they are taking when they leave a large balance. In one bank, the next major concept to understand is the bail. In a bailout, outside money is used to rescue the institution. Usually that means government money or central bank support. Taxpayers or currency holders bear the cost indirectly in a bail. And creditors of the institution bear the cost directly. Claims are written down or converted so the bank can be recapitalized. The Cyprus crisis in 2013 showed this in a very real way. The two largest banks were insolvent. The rescue included losses imposed on large uninsured depositors. Some deposits over 100,000 euros were converted into equity, and some depositors lost a significant portion of their uninsured balances. That was not a rumor, it happened. After that, bail-in frameworks became part of modern bank resolution thinking in Europe. Rules were formalized. In the United States, post-2008 legal frameworks also created mechanisms for resolving large financial institutions. Without simply repeating taxpayer-funded bailouts, regulators often prefer bail-ins because they appear to be more politically acceptable than bailouts. If taxpayers are angry about saving banks, then making creditors, bondholders, shareholders, and in some cases large uninsured depositors absorb losses can look cleaner. But from the point of view of the depositor with money above the insured limit, this is not a theoretical distinction. It determines who pays. And that is always the question in a crisis. Losses do not disappear, they move. They move from bank owners to bondholders, from bondholders to uninsured depositors, from uninsured depositors to taxpayers, from taxpayers to currency holders through inflation. Every financial crisis is in the end a distribution of losses. The person who understands the system asks, where am I in the loss distribution chain? The person who does not understand the system says, my money is in the bank, so it is safe. Those are very different mental models. Now comes the practical question that the source document raises. If banks are not perfect vaults, where should cash be stored? The honest answer is uncomfortable because there is no perfect answer. Every safe place becomes unsafe under certain conditions. Every protection has a weakness. Every form of liquidity has a trade-off. That is how reality works. Physical cash is the oldest form of banking independence. If you hold paper currency outside the banking system, it cannot be frozen by a bank. It cannot be bailed in. It does not depend on an app, a transfer system, or a branch opening on Monday morning in a bank holiday. Physical cash can matter in a deflationary collapse. Cash can become more powerful because prices fall and each dollar buys more. That was one reason cash mattered during the Great Depression. But cash has its own risks. It can be stolen, it can burn, it earns no interest. And in an inflationary environment, it loses purchasing power every year. If the crisis is deflationary, cash can protect you. If the crisis is inflationary, cash can destroy you slowly. That is why the question is not simply, is cash safe? The question is, what kind of crisis are you trying to be resilient against? Treasury securities are different. When you own a Treasury bill, note, or bond, you are lending directly to the United States government rather than to a private bank in a dollar-based system. Treasuries sit at the center of the financial architecture. They are treated as high-quality collateral. They are deeply liquid. They are backed by the taxing authority and money-creating capacity of the U.S. government. If you hold them directly through Treasury Direct, you reduce intermediary risk because you are not relying on a bank balance in the same way. But even that choice has trade-offs. Access can be less convenient. Selling quickly can be more cumbersome. The interface is not designed for ease, and treasuries still depend on the stability and credibility of the government and currency. If you hold treasuries through a brokerage, you add the brokerage as an intermediary. Your securities should be protected under a different framework, but the process during a failure can be slow and uncertain. Again, there is no free lunch. Money market funds are often treated like cash, but they are not bank deposits, they are securities. They invest in short-term debt instruments in normal times. They are highly useful. They can preserve liquidity and offer yield. But in 2008, the Reserve Primary Fund broke the buck, meaning its net asset value fell below $1 per S-share. Redemptions became stressed. The government intervened to stabilize the market. That intervention helped. But again, the principle is important. It was intervention, not magic. A money market fund is not the same thing as insured cash in a bank. Gold and precious metals are another old form of protection. Physical gold has lasted through regimes, currencies, wars, and banking systems because it is not someone else's liability. It cannot be printed. It cannot default. It exists outside the electronic banking system. That is why people reach for gold when they fear the debasement of money or the failure of financial institutions. But gold also has risks. It produces no income. It must be stored. It can be stolen. And history contains a very important warning. In 1933, President Franklin Roosevelt issued Executive Order 6102, which restricted private ownership of gold bullion and required citizens to surrender it in exchange for paper dollars that happened. So even an asset outside the banking system can be reached by law if the political system decides to reach for it. Silver and other metals have some similar characteristics, but they have their own volatility and storage issues. If you store precious metals in a bank safe deposit box, you may still face access problems during a banking shutdown or bank holiday. If you store them yourself, you face security problems. Every solution moves the risk. It does not eliminate it. Foreign currencies and foreign bank accounts can add another type of diversification. Holding assets in a country with strong property rights, traditions can reduce dependence on one banking system, one government, and one currency. Some people look to places such as Switzerland or Singapore because they want jurisdictional diversification. But foreign accounts bring reporting requirements, legal complexity, currency risk, and the need to understand another system. For Americans, foreign bank accounts above certain thresholds must be reported. Failure to comply can carry severe penalties. Offshore banking is not automatically illegal or suspicious, but it is heavily regulated. Again, the point is not to romanticize any one option. The point is to see the trade-off. Clearly, real assets are another category. Land, property, useful commodities, productive assets, and things that exist physically in the world are not the same as bank balances. They cannot be bailed in as deposits because they are not deposits. They can have utility beyond their financial price. A farm can produce food, a property can provide shelter or rent. Certain commodities can be useful in the real economy in inflationary breakdowns. Real assets have often done better than cash because money loses value relative to things, but real assets are not liquid. You cannot spend a farm at a grocery store. You cannot instantly convert a building into cash without a buyer. In a deflationary crisis, real assets can fall in price because credit contracts and buyers disappear. So even real assets are conditional. They protect against some risks and expose you to others. That is why when I think about risk, I do not ask, what is safe? I ask, safe from what? Safe from bank failure is not the same as safe from inflation. Safe from inflation is not the same as safe from theft. Safe from theft is not the same as liquid in an emergency. Safe from government seizure is not the same as easy to use. Reality is always a set of trade-offs. The system encourages people not to think this way. It encourages convenience. It rewards staying inside the system. Bank accounts are convenient. Apps are convenient. Direct deposits are convenient. Automatic bill pay is convenient. Brokerage accounts are convenient. And because convenience works most of the time, people begin to treat it as safety. But convenience is not safety. Convenience is just low-friction access during normal conditions. When conditions change, the same convenience can become a trap. This is why history shows that people who maintained optionality often did better than those who trusted one institution, one currency, one account, one country, or one story. They did not necessarily predict the crisis. They prepared for uncertainty. That distinction matters. Prediction requires being right about timing. Preparation requires being robust across many possible outcomes. In every banking crisis, the cost is distributed unevenly. In 1929 through 1933, small depositors in small towns paid a heavy price. They had little political power, They had little access to information. They trusted the nearest bank because that was what life required. The wealthy often had more options. Some moved assets into government bonds. Some held gold. Some used stronger institutions. Some saw the stress earlier because they had better information. In Cyprus, large uninsured depositors paid directly through bail-ins, while ordinary people also suffered through capital controls and withdrawal limits. In Argentina in 2001, accounts were frozen in the Corralito. Peso deposits were forcibly converted into devalued currency. Middle-class savings were damaged by rules most people never imagined would arrive. The pattern is not that every crisis is identical. The pattern is that the people who do not understand the mechanics are the ones most likely to be trapped by the mechanics. That is not a moral judgment. It is a structural observation. Systems do not protect the uninformed just because they are innocent. Systems distribute losses according to rules, incentives, power, and timing. The modern banking system is more complex than it was in 1930. But complexity does not remove fragility. Sometimes it hides it. Banks are interconnected through loans, securities, derivatives, payment systems, and confidence channels. Interest rate risk has become especially important. When interest rates rise quickly, the market value of long-duration bonds falls. If a bank holds a large portfolio of those securities and depositors demand cash, the bank may have to sell assets at a loss. That is what made Silicon Valley Bank such an important case study. It held a large securities portfolio. Rates rose. The value of those securities fell. Depositors became nervous. Withdrawals accelerated. Selling assets at a loss exposed the problem. Confidence disappeared. The bank collapsed in about 48 hours. That is a modern version of an old problem. The technology is faster. The app replaces the line outside the bank. The panic moves at digital speed, but the mechanism is still confidence meeting maturity mismatch. Emergency facilities can slow the process. Central banks can lend. Regulators can create programs that allow banks to borrow against assets at favorable values. These measures can prevent immediate collapse, but they do not make losses disappear. They move them through time or onto another balance sheet. As the source document explains, unrealized losses in the banking system were substantial after the rapid rise in interest rates. Not every bank is equally exposed. Not every loss becomes fatal. But the pressure is real because the structure is real. If inflation persists, central banks may need to keep rates higher, which keeps pressure on long-duration assets. If central banks cut rates aggressively to relieve the banks, inflation can return, the currency can weaken, and purchasing power can be hurt. This is the kind of dilemma that appears late in long debt cycles. There is no painless path. There are only different ways to distribute pain. When I look at these systems, I do not think in terms of good people and bad people. I think in terms of machines. A banking system is a machine. Fractional reserve. Banking is a machine. Deposit insurance is a confidence machine. Bail in authority is a loss distribution machine. Emergency lending is a stabilization machine. Inflation is a hidden taxation machine. A machine does what it is designed to do. If you understand the design, you can decide how much exposure you want to each part of it. If you do not understand the design, you confuse the machine's normal operation with a promise that it cannot fail. That is how people get hurt. The right conclusion is not paranoia. Paranoia is not useful. The right conclusion is clarity. Do not assume that a bank is a vault. Understand that it is a counterparty. Do not assume that deposit insurance covers every scenario. Understand its limits. And the difference between isolated bank failures and systemic crises. Do not assume that the government will always make every depositor whole. Understand that beyond the rules there are discretionary decisions. Do not assume that one form of cash protects against every risk. Understand that physical cash, treasuries, money market funds, precious metals, foreign accounts, and real assets each solve one problem while creating another. The goal is not to find perfection. The goal is to avoid being fragile in only one way. Harold in Nebraska was fragile in one way. He had one bank, one harvest, one deposit, one belief. When that belief failed, his options disappeared. The people who survive disruptions usually have more than one pathway. They have liquidity in more than one form. They have assets in more than one place. They have a plan for access. If the system slows down, they do not need to be brilliant. They need to be prepared. That is the larger lesson from 1929. Crises often look impossible right before they happen because people mistake long periods of stability for proof that the structure is safe. But stability can create hidden leverage. Hidden leverage can create fragility. Fragility can remain invisible until confidence changes. And when confidence changes, the adjustment can be faster than people imagine. In 1929, people trusted banks because banks had always been there. In 2008, people trusted mortgage securities because ratings told them they were safe. In 2023, people trusted regulated regional banks because regulation gave the appearance of control each time. There was truth in the reassurance, and each time the reassurance was incomplete. Deposit insurance exists, but it has limits. Regulation exists, but it has gaps. Central banks exist, but they face constraints. Governments exist, but they make political choices. That is why the central question is not, will the system fail tomorrow? That is the wrong question. The better question is, under what conditions can the system fail? And what happens to me if it does? If you understand that, you can prepare without predicting. You do not need to know the exact date of the next crisis. You do not need to know which bank will be stressed. You do not need to know whether the next crisis is inflationary or deflationary. You need to know that different conditions require different defenses and that no single defense is enough. That is how I think about risk. Risk is not volatility on a screen. Risk is being forced to sell, forced to wait, forced to accept terms, or forced to depend on someone else's decision at the worst possible moment. A bank freeze is risk. A bail-in is risk. A currency losing purchasing power is risk. A safe asset becoming inaccessible is risk. A real asset becoming illiquid is risk. A government changing the rules is risk. And the biggest risk of all is believing that because something has not happened in your adult lifetime, it cannot happen. History is a long record of things that could not happen until they did. That does not mean you should live in fear. It means you should learn from the autopsies. Study 1929 before you are standing in line. Study Cyprus before a bail-in becomes personal. Study Argentina before capital controls are announced. Study Silicon Valley Bank before digital bank runs become normal. The purpose of studying history is not to become certain, it is to become less surprised. Most people will not do that. They will wait until the sign is on the door. They will wait until the transfer does not go through. They will wait until they learn the difference between access and ownership under stress. That is too late. The time to understand where your money actually is, who owes it to you, what legal claim you hold, and what happens in a failure is before the failure. This is educational analysis, not financial advice. Nothing here tells you to buy, sell, or hold any specific asset. The point is to understand the structure so you can speak with qualified professionals and make decisions that fit your own circumstances. But the principle is simple. A bank is not a vault. It is a counterparty. Counterparties can fail. Insurance can help, but insurance has limits. Governments can intervene, but intervention is conditional. Cash can protect, but cash can be debased. Gold can endure, but gold can be restricted. Treasuries can be safe in one dimension and inconvenient in another. Foreign accounts can diversify one risk and create another. Real assets can survive monetary stress and still fail the liquidity test. There is no perfect safety. There is only a thoughtful balance of risks. That is what the people who were wiped out in 1930 did not have. Not because they were foolish, because the system had not taught them what the system really was. I think the same problem exists today in a more sophisticated form. The language has changed, the technology has changed, the institutions are larger, the backstops are more elaborate. But the core problem remains when too many people want out at the same time. Not everyone can get out on the same terms. That is the old truth inside the modern system. And once you see it, you cannot unsee it. The question is not whether the next crisis will come. The question is whether you will understand where your money actually is when it does.